Stuff. We love stuff. That's according to Ewan McGregor in a very clever yet profound Super Bowl commercial for Expedia.com that warned against the trappings of materialism and instead recommended a life more centered on experiences rather than the accumulation of stuff. While that message was indeed profound, it's somewhat off the mark. See, we don't just love stuff, we need stuff. Without stuff, we would freeze to death. We would starve. We'd kill each other over scarce resources. See, experiences like vacations, like dining out, or evening classes and underwater basket weaving are luxuries that are afforded to us only by the abundance of cheap stuff. Now, by stuff, I am of course referring to commodities. Those bulk materials that circle the globe on ships, on trains, and trucks, they keep our civilization functioning. And commodity markets efficiently supply the world with all the stuff we need to survive and thrive. Metals, food, energy, even coffee are all distributed throughout the world according to the functioning of healthy commodity markets. So imagine my surprise when I saw this week that JP Morgan was announcing a review of its business with some commodity clients. Very carefully worded statement by the world's biggest bank said, consistent with prudent risk management, we have been reviewing risks in light of significant market events. Understand that when a big bank issues a statement like this, announcing a review, what it means is that they've already looked under the hood and what they saw was ugly. Now they're trying to prepare us slowly for the bad news that's coming. And make no mistake, bad news is coming in commodity markets. The commodity markets have seen more than a couple of red flags in recent weeks. Many of you are familiar with the nickel fiasco that happened on the London Metals Exchange in March, where a major player in the space who wanted everybody to call him Big Shot was caught massively short nickel. Then when there was a sudden reduction in supply because of Vladimir Putin and his tanks rolling across Eastern Europe, Mr. Big Shot got margin called and whoops, he couldn't cover. And as the saying goes, when you owe the bank $1 million, you have a problem. But when you owe the bank $1 billion, the bank has a problem. And that bank was JP Morgan. You see, for every commodity trade, there is a bank that underwrites that trade. When Big Shot went way out on margin to bet against nickel, that bet was guaranteed by JP Morgan. That means if Mr. Big Shot loses money and can't pay, JPM is on the hook for making up the difference. In this case, Mr. Big Shot owed over 50,000 tons of nickel that was worth more than $1 billion.
Whoopsie daisy!
Now, the simple thing to do here would have been to liquidate everything that Mr. Big Shot had, and then JP Morgan eats the difference and they learn their lesson not to extend margin to imbecilic Chinese nickel tycoons who give themselves stupid nicknames to inflate their egos. That would have been the simple, ethical thing to do. But as any trader in precious metals will tell you, JP Morgan likes to change the rules mid-game so that they don't lose money. And that's exactly what they did. The nickel market was shut down and trades were canceled so that people who were looking at huge gains in their nickel long positions instead got closed out and had their cost basis returned to them minus any of the gains that they were entitled to. Then there were price controls put in place. All these sudden rule changes had one thing in common. They all made it harder for JP Morgan to lose money. So who would want to participate in a rigged market like this? Well, nobody. Since this blatant rigging of the nickel market happened in broad daylight for all the world to see, open interest in nickel futures has now fallen to multi-year lows. And it looks like aluminum and zinc traders aren't sitting around waiting for their turn either because open interest in those metals is also falling. As a matter of fact, right before making this video, the story broke that Trafigura was pulling vast amounts of zinc out of LME-approved warehouses in Asia. At this point in time, the commodity story is happening faster than I can talk about it. LME traders are getting out of Dodge. And can you blame them? The market is rigged. So with liquidity now draining from metal markets, coinciding with a vast reduction in supply from Russia, severe price volatility is all but guaranteed. In JP Morgan, you play stupid games, you win stupid prizes. What this story highlights is the concept of counterparty risk in commodity markets. When a short can't pay, the bank is on the hook. And although JP Morgan was able to sleaze their way out of this one in the nickel trade, they may not be so lucky next time. Another thing this story highlights is the risk that producer hedging poses to commodity markets right now. You see, in a healthy commodities market, producers like farmers, miners, and energy companies routinely short the commodities that they deal in as a way to hedge against sudden declines in commodity prices. In other words, they sell today what they plan to deliver tomorrow. In this way, the producers are protected from very sudden price declines. And if prices rise, it's not typically a problem because these are producers. They can cover their shorts with the commodities that are produced from their operations. As Zoltan Pozar recently phrased it, market participants are long commodities either in the ground or in transit and want to lock in a price by shorting futures. These include every commodity producer in the world, including Russia, and every major commodity trading house. But what happens when those operations are suddenly unable to provide the commodities that they've already sold? This is what happened to Mr. Big Shot in China. His nickel operations were mostly in Russia, and he found himself unable to supply the nickel he had already sold. So now this has JP Morgan wondering who else might be in this position. Turns out, everybody. Commodity markets have been red hot for months now, and that has kicked into overdrive since the Russian tanks started rolling across Ukraine. Producers of just about every commodity who are engaged in routine hedging now find themselves owing commodities that are far more expensive than the price they sold them for. Worse yet, with widespread supply disruptions and now economic warfare between superpowers, there are now severe shortages of these commodities. In other words, we are on the brink of a short squeeze in everything. Prices for every commodity, from corn to zinc to gold, are now up, and there are massive short positions both among speculators and producers, and those positions are being margin called. Now those shorts are sounding the alarm that they don't have the money to cover, and that is sending a chill up the spine of the commodity desks at all these big banks who now realize they're next. Now, these banks are currently extending lifelines to the commodity traders in the form of credit extensions, not out of the goodness of their hearts, but out of desperation to prevent a short squeeze. A note by Fitch Ratings on March 29th detailed how European banks, in particular, were extending lifelines to some of the largest commodity traders in the world amid what they described as a liquidity squeeze. You see, the mere act of these producers covering their shorts will drive those commodity prices higher, which will lead to more margin calls and more liquidations of these commodity traders. And eventually that'll lead to commodity markets across the board exploding higher, and that will leave the banks dangerously exposed to counterparty risk. That's what JP Morgan is worried about. And as always, the bond market is the first to sniff out this rot. Take a look at these charts from Bloomberg on March 16th. Now, one could be forgiven for thinking they're looking at the chart of, say, distressed Chinese developer bonds, but look again. That's not Evergrande or Kaisa. That's Trafigura, Gunvor, and Louis Dreyfus's debt, all trading at less than 85 cents on the dollar. Those are some of the biggest names in the global commodity space, and the debt market is dumping their bonds at a loss. Now, with their bonds being dumped on the open market, on top of a rising interest rate environment, borrowing costs are spiking for these conglomerates who desperately need that credit in order to keep their short positions alive. Credit they're getting from the banks, for now. But by extending credit to those shorts, the banks have essentially doubled down on those short positions, thus increasing their own exposure. In other words, the banks are now suppressing the price of most commodities in order to prevent the contagion risk from the hedgers from wiping out their own books. And as it turns out, this recent review at JP Morgan was not their first attempt to sound the alarm on this risk. As far back as March 8th, JP Morgan's head of global markets, Troy Rohrbaugh, warned about the counterparty risk to the bank in the commodity space. He said the markets are extremely treacherous at the moment. There are a lot of clients that are under extreme stress. That creates potentially very significant counterparty risk exposure. When the head of global markets at the biggest bank in the world and the largest player in the commodity space warns you about counterparty risk, you'd be wise to pay attention. JP Morgan is not alone in this. Barclays very quietly sounded their own alarm in recent weeks when they announced there would be no further issuance in the exchange-traded notes linked to volatility and oil. Now, Barclays was hardly transparent in their wording of this news, but it was obvious that this move was designed to limit their exposure to volatility and commodities. And by suspending any further issuance of new shares in these notes, Barclays was saying they would no longer be going out in the market and purchasing oil futures as money flowed into these products. As we learned during the silver squeeze, when money suddenly pours into exchange-traded products, the purveyors of those products become de facto short the underlying commodity. And Barclays didn't want to get caught owing oil with prices on the rise. This problem is about to get much bigger, though. Next Tuesday, April 12th, is the next U.S. Consumer Price Index, or CPI, reading. Inflation is already at generational highs with the 7.9% print we got last month, but this will be the first report since those Russian tanks started rolling across Europe. And when those tanks got rolling, we saw some of the biggest moves in commodity prices in history. So while people may be expecting a big inflation number, I think a lot of people are underestimating just how big it's going to be. This CPI print is going to be a wake-up call for people who are still in denial after drinking the transitory Kool-Aid for most of 2021. And the psychological impact of the biggest CPI reading since the 1970s will cause longs to pile into the commodity space even more, thus driving those shorts even further underwater when they're already overstretched. And I'm not alone in this train of thought either. Just today, JP Morgan released a report stating that commodities could be looking at 40% upside this year as investors spooked by inflation seek to increase their exposure to commodities as an inflation hedge. The timing of this note, right before a historic CPI print, is no coincidence. And worse yet, before markets have even had a chance to catch their breath next week after this CPI print on Tuesday, a day later we've got bank earnings start coming in. And considering all these recent statements by JP Morgan, it's reasonable to expect that they're going to warn about this contagion risk in the commodity space, that it's a threat to future earnings. At a time when mortgage applications are down, refis are drying up, and there's a rising risk of defaults as interest rates rise, we may be in for some serious fireworks in commodities and banks next week. This problem is so big that we're hearing whispers of emergency liquidity assistance, otherwise known as bailouts, being thrown around. For weeks now, the European Federation of Energy Traders has lobbied for urgent funding to the European Central Bank and the Bank of England in order to stave off a liquidity crisis. In other words, these commodity traders have their hand out to central banks asking for a bailout. More recently, Javier Blas penned this article over at Bloomberg referring to global commodity titans as too big to fail. Blas echoes calls for central banks to backstop liquidity at all these commodity trading houses. And he's using a lot of language that is eerily reminiscent of the global financial crisis and the early days of the pandemic. And apparently, central bankers are listening. Although no bailouts have been made yet, the ECB did signal a willingness to shore up liquidity at these trading houses if they see systemic risk. And Bank of England Governor Andrew Bailey recently went so far as to label the risk posed by commodity price volatility as bigger than after the global financial crisis, stating that commodities were the area of greatest risk to the financial system today. And he also said that resilience in these markets can't be taken for granted. Now here's the problem. As Zoltan Poser recently pointed out, you can print money, but you can't print oil to heat or wheat to eat. Central bankers can print money until they're red in the face. That won't make metal, energy, or food appear out of thin air. If the banks and central banks decide to backstop the shorts in order to protect their own interests, then we will have reached the point of global institutional price controls in everything. History has shown us that price controls simply don't work. The solution to shortages is higher prices. If prices are not allowed to rise, then shortages of everything will become endemic. That means globally we could be looking at things like bread lines, idle factories, empty gas tanks, and come winter, cold houses. But if banks and central banks don't backstop commodity shorts, then we're looking at a short squeeze in everything. And with CPI and bank earnings on deck for next week, this could start a lot sooner than most people realize. And if you want to know more about this subject, I've written a companion article to go along with this video at Brian Zarb's website, thetechnicalchartist.com. There is a link in the description down below. That article includes links to all the reference articles and all the quotes that I included in this video. While you're over there, check out Brian's website and sign up for his newsletter. Brian is one of the best technical analysis experts I've ever had the pleasure to work with, and there are big things coming on that website in the future. And if you want to know more about what's going on in the commodity space, you can check out this video that I did about 4 million fewer acres of corn being planted in the United States this year. Till next time, live small and dream big.